I'm Jeffrey Roach, Chief Economist for LPL Financial, and in this edition, I will highlight three key factors driving business and consumer activity. First, safe haven dollar adds risk to emerging economies. So the US dollar has climbed to a more than one-year high as investors seek safety amid a sharp global tech sell-off, reinforcing its role as a safe haven during market stress. So while anticipated Fed rate hikes remain supportive of the dollar's rally is also being fueled by broader concerns about equity valuations, debt-heavy investments in sectors like AI and semiconductors. The greenback is strengthening even as Treasury yields fall and equity markets stabilize, suggesting underlying demand remains strong and momentum with the dollar here could persist into the third quarter. Bottom line is this: a stronger dollar reduces the value of overseas revenues when converted back to US dollars, posing a headwind for multinational corporations, especially those large tech firms that earn a large percentage of revenue internationally. Second, more to go with capital investment. Demand for structural, non-residential investment has been a clear pillar of economic growth in recent periods. This category includes data center construction and oil and gas well drilling, other non-defense capital goods. These are providing a steady counterbalance to the softer components of growth, like the weakness in residential construction. So we expect even more business spending on equipment related to AI, intellectual property products, and non-residential structures as firms continue to invest in productivity-enhancing technologies and those emerging longer-term demand trends. Now, this strength has contributed positively to overall output, helping sustain real growth even as tighter financial conditions have weighed on interest-sensitive sectors. Third, China imported surprisingly less oil last month. One of the key questions for investment professionals is whether oil prices will return to pre-war levels once the Middle East crisis is resolved. At the same time, many are asking why oil prices are not higher, especially since the latest geopolitical deal recently pushed crude to its lowest level since the initial attack. Now, more than 100 days after the war in Iran disrupted the Strait of Hormuz, oil prices remain surprisingly contained, and one reason could be China's sharp pullback from the crude market. According to private sector data, Chinese crude imports by tanker fell to 6.7 million barrels a day last month, nearly 40% below the 2025 average. That reduction, which is roughly 4 million barrels a day, is enormous and equal to the combined oil consumption of Germany and France. This could be the central factor keeping prices low, as Beijing has somehow slashed imports without obvious economic damage other than a slowdown in year-over-year GDP growth from Q1 to an expected slowdown to 4.6% in Q2. So that's all for now. If you want more insights, follow us on social media and take care.